Hey, everybody. Welcome to this week's version of the Multifamily Investing Academy podcast hosted by me, Charles Dobbins, themultifamilyattorney.com, and the man, the myth, the legend. So, and here I have with me Doug Marshall, and he is an award-winning author, and we're going to talk about his book. He's going to get his book right now. He's maybe not. So he's an award-winning author, which is incredibly presumptuous of him on his part, thinking that the audience of my podcast actually knows how to read, which, the jury's still out on that one. But Doug is, as you can see by his look, he's seasoned. He's a seasoned real estate professional, and he's got over 40 years of experience, mostly on the lending side, okay, which is good because we're going to talk about some of these things. Now, he launched Marshall Commercial Funding, an independent commercial mortgage brokerage house headquartered out in, and as I was just saying, the liberal bastion capital of the world, Portland, Oregon. Hey, do you know my buddy Brendan Burchard?
Don't know him.
Oh, gotta look him up, man. He is. I am who I am today, thanks to that man. Now, for the past 12 years, he's also been investing in commercial real estate. We're going to talk a little bit about his experiences with investing. The name of his book, and this is a great book, and I want everybody to run out and get this book, is Mastering the Art of Commercial Real Estate Investing: How to Successfully Build Wealth and Grow Passive Income from Your Rental Properties. Douglas Marshall, welcome to my podcast.
Well, thank you very much. I greatly appreciate having the opportunity to be on your show.
My pleasure. All right. Now, the thing is, Doug is one of those guys. He's a very analytical guy. I can tell this already because he actually came with a list of questions that he wants me to talk about. And I got to tell you, I really like some of these questions. These are great questions, and we're going to delve into it, but we're going to do it in a particular way, where I'm going to, one of the ways that I teach and one of the things that I do is I try to shift people's paradigm. I want them to think differently about coming at this business. And several of your questions look to be that type of perspective. And so I'm going to call you out on it, and I'm going to see if your paradigm matches up with my paradigm, because you've got some very interesting points in here that, all right, we'll get to it. We'll figure it out. But all right, Doug, how did you get into the greatest business in the world, which is real estate? What is your history?
Well, my history, I think you've given a pretty good explanation so far, Charles. And I started in 1980, and right out of college, and I started working for a real estate developer, and I spent 7 years with him in a variety of different capacities. And then in 1988, I believe it was, I started on the financing side of the business, and I've been on that side ever since.
Boy, that wasn't a good year to start, was it?
No, it really wasn't. But
you timed that one right, didn't you?
Yeah. Well, let me tell you what happened. In 1986, the Tax Reform Act hit.
Right.
And I became, in 1987, I was unemployed because the way that took place, all development stopped, and it stopped for a good bit of time, about 2 years. Oh. And so I was let go. I ended up working for a Fannie Mae lender, and I learned the ropes there. And it's from that I ended up on the financing side of the business, and actually that's where my strengths lie. I did have 3 years as a property manager for Class A apartments in Atlanta and in Nashville. I had about 700 units under me, and it was the longest 3 years of my life. Yeah. I wouldn't wish that on my worst enemy.
Man.
So now I am very comfortable on the financing side, and have been for these many years.
All right, then I got to ask you, before we even delve into your question, I'm going to get right to the heart of the matter, and I want to get your perspective. What's going on in this marketplace right now?
Well, it depends, I think, a little bit on what region of the country you're in. And in the Pacific Northwest, is which I can really talk to. I think that the real estate market cycle peaked about 2 years ago. And so we're now kind of in that quadrant where rents have gone up dramatically over the years, and now you're seeing a substantial slowdown in rents, rental increases. It's
Okay.
still positive, but there's an increase in vacancy, and in pocket various neighborhoods, you're going to start seeing some concessions in the marketplace, and as the new product comes online. So I see the market slowing down, and we're not in that terrible decline that we saw in 2009.
Right.
But we're heading in that direction.
I think based upon like comparing it to 2009, just the financials fundamentals are much more sound now than they were back then. I mean, with those, liar loans and the CMBS world, I don't think we're in that world anymore right now.
I agree.
But the thing is, if you look at it from a basic standpoint about who's your customer, and we could, as long as our customers are growing and making more money, our business will do well. And then it's a supply and demand issue. But right now, what we're seeing, and I just looked at the numbers the other day about Boston, and the numbers in Boston are ridiculous as far as record low vacancy. I mean, some submarkets are at 1.4% vacancy in Boston. Yeah, and then
amazing.
Some year over year increase in some submarkets are 9% increase in Boston, and they're just building. They just keep on building. It's crazy. But the thing is, at some point, you run out of 25-year-old kids that can afford a $2,400 one-bedroom apartment. At some point, that's going to happen. That's what I say is the breaking point, the tipping point of this market.
I agree with you. And what's happening is, and we're having the same situation in Portland, we have our downtown area that has just boomed, and they're building these Class A apartments.
Yeah.
That the typical rent is between $1,800 and $2,200, and there's only so many people that can afford that, and we're beginning to see the substantial vacancy in that area, and I think it's going to trickle down at some point where rents are going to have to stop growing in other parts of the market, and I think we're going to see hopefully it'll be a gradual decline. That's still possible, but I do think that we have peaked, and I think it'll be interesting to see what happens in the next year or two.
Well, and this is going to be a shock to maybe to everyone in our audience, and maybe even to you too. But this is why you and I are going to vote for Bernie Sanders, is because.
Well, that's interesting. I didn't know I was going to be voting for him.
I told you it might be a surprise to you too. But I got to tell you, one of the things that I think is a driving force, more so than most people will give it credit, is the student loan debt. Yes. And this is impacting housing starts. It's impacting new home ownership. And what we're seeing in my marketplace down in the Boston area, south of Boston, is $1 million homes are selling, but starter homes are not. Once you make your money and you're doing well, then you go out and you buy the big $1 million house. But before that happens, you don't want to, you're in a rental capacity. So it's that student loan debt is when the government took it over, Katie barred the door. It was off to the races, and it has it's unbelievable. It's disgraceful, absolutely disgraceful.
Well, when you think about tuition, college tuition, and how ever since we started liberalizing the student loan program to make it easier for everybody to borrow for tuition, the amount of the cost of tuition has been double digit in most places for a number of years. So now it's becoming less and less affordable to be able to get that college education. When I was going to school 100 years ago, I could actually work during my summer, and the money that I put aside for the summer would take me for the entire year, including tuition.
Cannot be done. No longer be done.
Yeah.
Unbelievable. And the other problem with the student loans is or colleges is they're running out of customers. I mean, you're seeing we have 50 colleges right here in the Boston area, and give it about 10 to 15 years, it'll probably be 25 because they're all going out of business. They're all consolidating because they just don't have the customers anymore.
Yeah.
And I'll tell you, I went to Boston College, and there was a school of nursing. And you all know what nurses make when they come out of school. But those poor nursing students, those girls worked harder than anybody else. I mean, they were up early, and their income is capped, but the tuition is the same as what I paid. We'll go out and we go out and become lawyers and stuff. I got the same tuition payment that my sister, the nurse, got at Boston College. So it's just there's got to be a give as far as what the trade value is of that degree. So anyway, all right, Doug, you took me down a tangent. Okay,
yes, I did.
Yes, you did. You didn't even know you did. It's when you told me you were voting for Bernie Sanders. That's what it was all about. All right, so let's get to your list, and I'm gonna get you on your list. Now, I want you to tell me what you consider the 4 major differences between real estate investing or multifamily real estate investing and the stock market. And I know one of them in my mind. I can think of. Let's see if one is one of your 4. Go ahead, give it to me.
Well, unfortunately, or not unfortunately, actually, I believe there are 4 that are well known, Charles. They're kind of like everybody ticks them off, and they all know them. And then there's 3 that are not so obvious. So let me quickly go through the 4. And then I'd like to focus on the 3, if that's okay.
Yeah.
So the first advantage of real estate over over stocks and bonds is cash flow. You really can get substantial cash flow from your properties, where if you get anything from your stocks and bonds and dividends and whatever, it's relatively a token sum. But with real estate, you can get substantial cash flow. Secondly, you get to defer your capital gains taxes through a 1031 exchange. You can't do that in any other type of asset that you own. There's no deferring of capital gains. You pay it that year.
Yeah.
Thirdly, the advantage of having a depreciable asset and how that shelters your income. And you can get into situations I did last year where I had a tax loss, but the properties were generating a positive cash flow. It was like the best of both worlds.
Yeah.
And you don't have any depreciation with stocks or anything like that. And then number 4 is that you can use debt to purchase a property. And so you can leverage your property, which improves your cash on cash return. You don't have the same type of advantage with any other type of asset. So those are the 4, Charles, that people know. And but I think there's actually 3 more that are just as important. In fact, maybe more important.
Go ahead.
The first one is the concept of efficient versus inefficient markets. Now, an efficient market is the stock market. You buy and sell your property based on a sales price that's stated. Okay, you can't buy any lower, you can't buy any higher. That's what you're buying it at. But on an inefficient market, which is perfect example is real estate.
Yeah.
You have the ability to buy things at a bargain price because the purchase price is negotiated between buyer and seller. And if you, as the buyer, have a vision for that property that the seller doesn't have, then you can buy at a bargain price because have a better sense of what the value of that property is. And so there's that advantage of being able to buy an inefficient market. So that's the first one.
That's really interesting. I like the way how you compare it to, the difference is because of a person's vision. I mean, I just had this conversation with a student the other day, and we're trying to figure out why are there offers on the table that are $500,000 more than what he's calculating his numbers for?
Right.
And the answer is those other offers have a different vision of what this property can be than you're coming at the table with.
And the interesting thing is, Charles, is that nobody really knows who is correct.
I know. Yeah.
Until maybe a year later, was that that higher sales price justified? Were they able to make the changes to improve it, or were they just, like some people just start buying things and not think about the consequences?
We call those California investors.
That's exactly right.
Yeah, I see you even.
I would know that more than you.
Exactly, you're over there. You see it all the time.
Yeah, exactly.
Yeah. Now but that's an interesting point. Is that remember it's the concept of highest and best use,
yeah,
which is nothing more than someone's opinion.
Right.
And it really does. It shows the inefficiencies of the real estate market, which is what we can take advantage of.
Exactly.
Yep. There's one other thing that the disadvantage, and this is something that I talk about that, I haven't heard anybody else talk about, the disadvantage of multifamily or real estate versus stocks. And that is that when you go to sell your property, you got one bite at the apple. You got to sell that at the highest price possible, because it's unlike a stock where, I'll sell 1,000 shares today and I'll sell another 1,000 shares next week, see what the market does. You got one bite at the apple. And that's a major difference between real estate and that, the stock market.
Well, and another disadvantage right alongside that is that it is an illiquid asset, and it might take, in a down market, it might take a year or two to sell something. That happens. Or in a good market, you might be able to get 3 offers in the first week. You just never know.
Yeah, and the thing is too, and this is, you said it could take a year or so to sell it, but it could take a year or so to prep it for sale as well. And then you got to, okay, we're on the market. It might be a 12-month window starting then.
Absolutely.
Yeah. So there are some, this is but our job as investors is to take advantage of these inefficiencies, right, and maximize them. And that's something I teach my students all the time. And, some of them are so anxious to get into the deal that, like, it's just woe down there. Let's be smart about this, because, the worst thing you can do is overpay for a property. Worst thing you can do.
Yep. Now, I mentioned that there was 3 not so obvious. We've gone through the first one with the concept of efficient versus inefficient markets. The second one, Charles, is that real estate owners have considerable influence over the outcome of their properties. You don't have any influence if you have a stock or a bond. You have absolutely no impact whatsoever. But a real estate owner, they can make improvements to the property. They can change the management of the property. They could re-tenant the property with a better quality tenant.
Yep.
And so you have a substantial influence over the outcome of your property. And so instead of being just a passive, owner of some stock, you actually can influence the outcome to improve the value of your asset. So that's number 2.
And no greater example of how that is true is you try to show up at a stockholder meeting and influence the board, just little old me. I mean, they'll get up, walk away, and behind the closed doors, they'll just laugh at you. I mean, but here with the multifamily, it really does have an impact.
Yep. And the final reason that's not as obvious is that I believe owning real estate through passive income, you can achieve financial freedom. Mm-hmm. The other, it's a dire mistake to put your retirement account into stocks and bonds because they don't generate the passive income. So, in my opinion, passive income is the way to achieve financial freedom. And the best source of passive income is real estate. Yeah. Yep. Amen, bro. Amen, brother. Amen. Yeah. Preach it, Doug. Thank you. Share your heart. Okay. Now let me ask you this one, because this goes right to what I do with my students, my clients. So, and I really want to get your perspective on this one. Is why do you think people say they want to buy? Why do you think that people who say they want to buy a multifamily property end up not doing it? And I got 10 reasons for there, but let's hear yours. Well, I think that it primarily boils down to fear. And it's really, there's 2 types of fear. One is the fear of failure, and the other one's the fear of the unknown. So fear of failure is all about having a mindset of you win or you lose. And because of that mindset, it becomes very debilitating it makes it very difficult to make a decision, because if it's going to be either a win or a lose, you're always asking for more information. You're trying to get more and more information, and you'll never have enough. And so people, they just, the default position for that type of mindset is do nothing. And so they'll talk a good game. Over the years, I've had people call me and say, I'm going to be buying my first rental property here pretty soon. And when I do, I'll have you finance it for me. And so they pepper me with a bunch of questions, and they go away. And about 6 months or a year later, they come back and they say, as soon as I can find that right property, I'm gonna have you finance it for me. And the reality is they're never going to finance. I'm never going to finance a property because they're never going to purchase one. So they need to change their mindset. And this is incredibly important, really, Charles. This is the key. You need to change your mindset from you win or you lose to you win or you learn. And everything we do, we either win, we make the right decision. We can do the happy dance because we made the right decision, or we learn what not to do so that the next time we have a higher probability of success.
Yeah.
I realized that over the years with my my clients that are highly successful real estate investors, they really understand and practice this truth. They may not be able to verbalize that thought, but that's exactly how they live. They will invest in something, and if it doesn't turn out like they think it's going to, then they just kind of move on, and they kind of say, well, I learned something there. And they don't beat themselves up over that.
Yeah. I mean, you didn't fail. The deal failed. The business failed. You didn't fail. Listen, that lesson had to be taught to me the hard way. And, because when one of my early businesses failed, I took it on personally. And that, I had a lot of good advice from people to teach me that it wasn't you that failed, it was the business that failed. And fortunately, because of anyone that says they've always made money in real estate, never lost anything, is a liar.
That's right. That's sure.
And so, if once you learn that it's not you personally, it's just the business, you just keep going on. I mean, right. This is, people think, oh, I lost money in real estate. Yeah, but I bet you made money in real estate too. I mean, if you did it right and you keep at it, you eventually you're going to figure this thing all out, and it's going to work for you. Now, when you talk about the success or the failures, how about yourself? I mean, as far as some real estate deals that you've done that have gone, what lessons have you learned from some of your failures?
Well, I've been fortunate. The very first property that I owned, that I invested in, is with a group of investors, and I call it my loser property. And reality, we did make money on it, but we held it for 8 years, and the internal rate of return on that investment turned out to be about 7%. In other words, we could have put that money in the stock market at that particular point in time, and we'd have made a whole lot more money. So that's the worst investment that I've had. I've been very fortunate, but I learned 4 things from that investment. And I think they're important to understand. First of all, we bought it right at the peak of the market. We bought it in June of 2007. And if you can recall, I think June of 2007 was the absolute peak of the market.
Doug, you timed it wrong.
Yeah.
You had until October of 2007 before things started. Yeah, I timed it. I got one of those stories too. So
okay, well, I learned 4 things from that owning that property, and it's really important that you learn from your mistakes. I mean, you're going to make mistakes in real estate. There's just no way you cannot make mistakes, but. I learned
the biggest mistake you can make is not learning from your mistakes.
Exactly. And so when somebody says, oh, I lost money, in real estate, well, you should say, well, what did you learn from that?
Yeah.
And if they come back with a puzzled look on their face, that they don't get it. There are reasons why you lose money in real estate.
I am so good at what I do, teaching people how not to make mistakes, because I've pretty much made them all for everybody else. So why recreate the wheel? And those people that sit there and like tell you all the times they made money, you're like, wow, you must be the stupidest person in real estate, because I learned more from my mistakes than I ever did from my successes. So I obviously know more than you do, Mr. Midas touch real estate investor. So, all right, let me ask you this. You said there are 5 questions that new investors should answer or should have answered before buying their first rental property.
Yes.
Let me hear. Let me hear what you think.
Well, it goes back to the fear of the unknown. And if you answer these 5 questions, I'm not saying it totally solves the fear of the unknown, but it certainly significantly reduces your unknown. Okay. And therefore, you can go forward. So the first one's really an obvious one, Charles. It's almost embarrassing to ask it, but I'm going to do it. First question is, do you want to be an active or a passive investor? You know, an active investor makes all the decisions about the property, and a passive investor is one lets somebody else make all the decisions. So the first question right out of the box is, which do you want to be? A lot of people just think that the only way they can own real estate is as an active investor. I will tell you right now, right up front, I'm a passive investor. I let somebody else make all those decisions. And I'm more than happy to get my monthly ownership distributions and let them, have all the fun of managing the property on a day-to-day basis. Seems like a really good situation to be in, and that's where I'm at. But so you have to ask that question. And if you want to be a passive investor, then the only real question you have to answer is who do I want as my real estate sponsor? Or maybe better yet, who do I want to, trust with my money? And once you've made that decision, you can kick back and relax. You're done. But if you're on the other side, let's say you want to be an active investor, you have 3 questions that you need to answer. One is, who do I want to have on my real estate advisory team? Who would be really helpful for me? Where are my areas of weakness that I don't have a lot of knowledge? And I need to find the right person to fit that spot, and so that I can use their wise counsel so I'm making good decisions. So that's the first one. Very important. And then the second one was, how do you want to finance the property? And you have, 3 different ways of financing a property. You can either go back to an existing lender that you've used before. You can shop the mortgage market on your own. Or you can use a commercial mortgage broker to do it for you. And hands down, I know I'm biased because that's my background, but you're going to do a whole lot better if you use a mortgage broker than trying to do it on your own. And then the third question is, how do you want to manage the property? You could self-manage it. You could hire somebody to manage it for you that reports directly to you, or you could just hire a property management company. So once you've made those decisions, you have significantly reduced the uncertainty of investing, and all the other decisions, myriads of decisions that you have with owning real estate, they really begin to fall in line once you've made those decisions. So, the first problem is fear of failure, changing your mindset till you win or you learn. And then here, you just answer these 5 questions. And if you answer those 5 questions, you've really significantly reduced your uncertainty of investing.
What I always say is owning real estate changes your life. And you need to understand how owning that property is going to change your life, and whether, you're, like you said, passive or active, which one do you see yourself being? But then also, if you decide you want to be active, what quality asset are you looking to buy? I mean, If you're looking to buy a C-class property, man, that's going to keep you up nights. If you're looking to just kind of be, still run your day job and be the active investor for syndicating a deal for others, then you're looking for an A-class property, because those are easy. I mean, those are, you get no problem with those. So now another thing, let's talk about something else that you just mentioned that I think is was a kind of an eye-opening experience for me when I first got started in this business. And I see a lot of new investors coming from the single-family world into the multifamily world and into the commercial mortgage world, and they don't quite understand how it's an entirely different world than where they came from. And that is working with a mortgage broker, because behind the scenes, there really aren't a whole lot of sources for commercial capital. But finding the right mortgage broker is going to know right away, this deal should be over here. And, with residential, you flood the market with your applications for mortgages. If you do that in the commercial space, you get a bad rep. I mean, when
All
Fannie
good
Mae,
points.
yeah,
All good points.
yeah.
I applaud you.
Yes, thank you. Well, tell me, describe for me, how it works with you. If I came to you with a deal and you'd never looked at it before, tell me what you do when I drop that application on your desk.
Well, I would look at the historical operating statements on a property and the current rent.
How far back do you go?
What's that?
How far back for the income and expense?
I would go, if I could do it in a perfect world, I'd like 2 full years and year to date. It shows me trends. And yeah. I don't even look at the marketing flyer. The marketing flyer is so overstated on income and understated on expenses. They must think that we're idiots to actually believe what they're putting out. So I just look at
I had one student I worked with years ago, and this guy had every offer he ever made was accepted. But he never once closed on a deal. And I said, how do you do this? Like other students of mine, probably have like a 10%, success rate in getting their deals accepted. How do you get all of your offers accepted? He goes, well, I just offer the pro forma price. Well, of course, that explains everything. That's why all your deals are going to be accepted, but none of them are going to pass muster. You'll never get them through underwriting. No. So okay, so you got 2 years. Now, here's something that came up the other day that kind of threw me for a loop. Is the government-sponsored entities will look at 3 months of income and 12 months of expenses.
Right.
Yeah. Okay, fine. But as an owner operator, I'm the guy that has to run that baby. I want to see all 12 months of income.
Oh, absolutely. And what you don't understand is that Fannie Mae or Freddie Mac, they're in the business of financing the property.
Yeah.
And that's great. And they historically have the best rates in terms for apartments. But you need to understand what is the potential cash on cash return on that property, assuming you can get one of their loans. And you need to know the historical operating statements. You need to be able to ask questions. Why is this blip in here? What is this? Maybe there are things that you could justify to take out. Many times capital expenditures are expensed instead of capitalized. So you need to understand that. But the point is that you, as the buyer, need to have a really good understanding of the historical operating statements. And then secondly, you need to have an idea of how you think it will play out going forward. I mean, what are you going to do? See, today, at least in the Pacific Northwest, probably in Boston as well, if you buy something at market, you're not going to get the cash on cash return you need. So The only way you can justify purchasing something today is if your vision for that property is better than the vision from the seller. And the seller is just kind of tired and wants to get rid of the thing. And you're going to sit there and say, if I make these 2 or 3 tweaks, then I can get an acceptable cash on cash return. And so that's how I kind of look at it.
Yeah. I mean, it's like, from that standpoint, looking at the financials, it's kind of like what your mother and my mother told us about multifamily property, where they said multifamily property is like a woman. You've got to see her in all 12 months before you marry her. Remember when your mother told you that, Doug?
I can't recall her telling me that.
No, I heard her say that. Of course she did. My mother always said that to me. So you got to see the woman in all 4 seasons before you marry her. And that's true. I mean, because you got to see the trends of the income, not just the trends. I mean, and like you said, hey, granted, they are your partner. They're your debt partner, but they're a profit-making company as well. And if, they can get a deal through with a 1.2 debt coverage ratio, hey, they'll make the offer to you, but it doesn't necessarily mean that it's a good deal for you guys, for the investor.
Right. Absolutely.
Yep. So, all right. Hey, listen, we're talking about a shifting paradigm thought here. And this next question I really got to get your perspective on this one. Where you say, don't pay attention to the internal rate of returns when you're buying a property, because because I mean, okay, I want to hear your explanation, and then I'm going to throw some shade on it, and we'll see how we do. Go ahead.
And then you'll eventually agree with me, Charles. You see, so
Oh my gosh, he sounds like me.
I'm going to be voting for Bernie Sanders.
Yeah, exactly. Oh dear God. Oh dear God.
Okay, so
By the way, just before you answer, I want to tell you that right now we're shooting this. I'm up here in New Hampshire, the first in the nation primary state, and so I've been witnessing the election cycles for 72 years now, and so there's a vibe here in New Hampshire that I think nobody else is picking up on. The stupid CNNs, the stupid MSNBCs are all going for their town hall meetings, and but they're not looking at what's going on in the grassroots right here in New Hampshire. And there is one candidate who's got a very, very powerful boots on the ground here in New Hampshire, who I think is going to be a sleeper surprise at the end of the New Hampshire primary, where everybody else will start talking.
Can I make a guess?
Yep.
Governor William Weld.
Oh dear God. Oh dear God. Are you kidding? He is the biggest joke. He's even a joke up here in New Hampshire. I mean, he's a joke in Massachusetts. He's a joke down there. No, I'm talking about a Democrat.
Okay.
You want another crack at it?
Well, you've been talking about Bernie, so is it Bernie?
Oh gosh, no. This one's a sleeper. It's a sleeper. Like,
okay,
this person's not even on the debate stage anymore.
Oh,
yeah.
Is that the mayor?
Oh no, he's on the Buttigieg. He's on the debate stage. You ready? You ready for it?
I'm ready.
Tulsi Gabbard.
Who's that?
Senator from Hawaii.
Oh,
okay. Doug. Yeah, no, she's a veteran, attractive woman, very articulate. She's not one of these progressive liberal types, but around here, her signs are everywhere. People are standing on the street corner in the middle of the day holding her signs. She's got a very strong campaign going on here already. So
interesting.
Yeah. So mark my words. You can take that one to the bank too, Doug.
Okay.
Yeah. All right. Good. All right. So let's get back to internal rate of return, because this could be a paradigm shifter.
Yeah, could be.
Go ahead.
I'm glad I'll be able to change your position.
Yeah. Okay.
So
I'm not voting for Tulsi. I'll tell you that right
now. When I got started back in the business in 1980, the first job I had was I worked for a real estate developer as a financial analyst. And one of my responsibilities was to run the numbers on future developments, typically apartments. They did other things, but mostly apartments. And if my numbers didn't generate a high enough internal rate of return, I was asked to, work the numbers, tweak them until I did get an acceptable return. And, he was playing the role of a syndicator back then. And so he had many partners that were, that he was, that were coming along and investing with him. And so we needed to make sure that had an acceptable rate of return. So I learned how to so easily manipulate the numbers. And if I didn't get a high enough IRR, well, then I would just increase the inflation rate 1%, or I would lower the cap rate in year 10. And so I learned the hard way that you can make the IRR number say whatever you want to. And so that's why I'm not a fan of IRR. Now, I know it backwards and forwards. I do. And let me give you an example of when I do use it. I strongly use it one time during the process. And that's after I sold the property.
Oh, okay. Yeah, because I was wondering. Okay, go ahead. Yeah.
So once you've sold the property, everything is known. When you got a forecast, you have no idea how many years you're going to keep it or whatever. But here, the number of years you've owned the property, the amount of cash flow that was generated by year, how much equity you put into the property when you purchased it, what the sales price at the end was and how much debt you had. And so, the equity. And with that, you can then do an honest calculation of IRR. Like I told you about my loser property had a 7% internal rate of return. I know that because after I sold it, I wanted to know. And but I wouldn't do it beforehand because you can just do it. You can make it say whatever you want it to say.
Okay, so let me ask you this.
Yeah.
So you don't even look at it, but man, now you're kind of hamstringing me a little bit, because I don't know if this next question is a good one. I was going to ask you, like, so what do you consider to be a good IRR? I mean, 7% wasn't good.
No, 7% is not good. I think realistically today, if you have a good property, one that's healthy, it should generate somewhere between a 15 and 20% IRR.
Okay, let's qualify healthy. You mean a performing asset?
Yeah, performing asset, something that, in the last 10 years that you've had. I have, I do IRRs on my existing properties, so I update them on a regular basis. I have 2 right now that are in the high 20s. I mean, they've just been cash cows. They've been absolutely fabulous. So, but let me also give you another example of how to use IRR, which I love to use. This is a good way.
Okay.
I did it just recently. So I had a client who is looking to invest in a property that's a new construction, and he gets the marketing piece from the developer. I will say this, that it was well thought out. They weren't trying to overstate returns on it. I felt like I was dealing with honest people, which is kind of that doesn't happen very often. So I looked at the numbers and I saw that his IRR calculation as an investor was 12.5%. And I said, I don't think that's good enough for something like this. And I said, now, and they had a fee split at the back end. And so I said, what if I were you? Okay, they give me a 12.5% IRR. Say to them, I need a 15% IRR. And so to get my 15% IRR, they have to change the fee split on the back end and then go back and present that to them. And you see, that's a way that you can use IRR to your advantage. You go back to the person that gives you that pro forma and you say, oh, it's not good enough. But if you want me as your investor, you give me a 15% IRR by reducing your fee split on the back end, I'll be happy to invest in it. And that's a way that you can use it as a tool.
Okay, let me just add to this, all right? Because what you're saying is very similar to another lesson that I teach my students, which is listen to what the broker tells you and always use his words against him.
Exactly.
And like one time when I was out walking the property, broker said,
that is a perfect, I'd like to write that down.
Write it down. It's in my book, Commercial Real Estate, the Mastering the Art of Commercial Real Estate Investing 2. Yeah. It's kind of a catchy title. I just kind of picked it up.
Yeah. I like that title.
But I had walking around with this one broker, and he was telling me how great the occupancy was. The property never went below 95%. All the time that they wanted, never went below. So we ended up having a rent guarantee that if the rent, and they set aside $100,000 for the first year in the escrow with the escrow agent. If the rents fell below, if the occupancy fell below 95% at any time during the course of that year, I could go and draw off of that $100,000 and bring me back up to 95%. At the end of 12 months, Doug, how much money did I have left over in that escrow account?
Nothing.
Yes. Nothing. Yep. Because the broker lied to me. That property was never over 90. Yeah, can you imagine?
I can't imagine that.
Oh my gosh, Doug. What are we, like, separated at birth? I mean, because it's you and I feel the exact same way. I mean, you just don't trust these guys. All right, so wait a minute. So I totally get it where you're saying with the IRR, and you're absolutely right.
Did I change your point of view?
Well, no, you're right. But now let me build on this, because we got to look at something as to determine whether the deal is a good deal or not. And cash on cash return is just as manipulatable. How do you like that word? Manipulatable. As IRR. So what is it that you look at? Well,
first of all, I would disagree with you on that statement, that it's as manipulable, whatever that word is. It could be that, but you see, maybe you just don't understand the definition of manipulatable. So yes, that's what the problem is. If you have the historical operating statements and current rent roll, and you make a projection of what you think you can do to tweak the property. That is not going to be manipulated by anybody. That's the real numbers. And then your projection going forward is your numbers. Now you could maybe convince yourself of a more rosy picture than reality, but at least you're not going to be working off of the sales flyer on that property. So, and I do believe on cash is the only really way to go forward. Now, what I do think though is that it really varies from one part of the country to the next. For me, I like to see a 5% cash return in the first year. I will settle for something less than that if I realize that going forward there's going to be a significant improvement in the NOI in that property. So, but I know if I were in California, they would, or if I were in New York City, probably in Boston, but in New York City and most of California, you can't get a 5% cash return. It's impossible. You're basing your purchase based on appreciation going forward.
All cap app.
Yeah. So it depends on what part of the country you're in. Now, if you're in the Midwest, you're in Ohio or something like that, they probably can get cash returns approaching 10%, but they have no appreciation. I mean, there's no, if anything, maybe they might even lose value in some places.
Yeah.
So
slow and steady.
Yeah, but that gives you a nice cash on and you just better hope that you can sell it when you want to sell it in 10 years because their population base is declining.
Yeah.
In some states. So it just depends on where you're at. But in the Pacific Northwest, 4 to 5% is something you can achieve if it's not easy to find it, but you can find it.
Okay, but you said it's based upon the region, but my issue is it's also based upon the asset type or what your plan is with the property. Because, one of the things is if you bring me a value add deal, if you bring me a non-performing asset, don't even talk to me about cash on cash returns. We can't even discuss it. It's not even on the table. You've got to show me why we're going to put $1 million into this property for rehab.
Yeah.
Prove it to me on the back end. And that's really when the IRR starts to look a lot more palatable.
No, you're doing good until then.
I knew I was trying to throw you that curveball.
No.
Caught me.
No.
He caught me right at the end.
And the problem with going back to the IRR is that you don't know how long you're going to keep that property.
Yeah.
You don't know what the cap rate's going to be in year 10. You don't know what your cash flows are going to be during the holding period by year. So no, what you do is you say, okay, I've got a cash on cash return right now of X. Can I improve it? And if I think I can improve it, and then you can think about it going forward as saying, well, I'm going to trust my judgment that when I do sell this property, that I'm going to get an acceptable offer for that. It'll be an appreciated value than what it is right now. And between the cash flow and the
sales proceeds,
you're gonna make a nice, healthy return.
All right.
But I can't tell you what is an appropriate cash on cash return for Boston. It'll be lower than it is in Portland.
Yeah, because but we're dealing with 3-4 cap properties.
Yeah, I don't even understand that market. That's totally foreign to me.
Oh wait, well let me tell you. How do you explain the Southern California market where in order to get the debt coverage ratio numbers to work, you got to put 50% down?
Yeah.
That's just why?
Yeah.
Why? What when does the money flow out? Of it. Why do people still stay there and buy? I just don't get it.
Well, they don't. Well, they do, but we see a lot of the properties that are bought in the state of Oregon historically are bought by Californians because they can't get the return they want, so they come up to Oregon and they purchase a good. I don't know. I would be interesting to know, but I wouldn't be surprised if a quarter of our properties are purchased by Californians.
Yeah. Yeah, Oregon tends to be like the retirement capital for California. It's like a lot of government workers from California move up to Oregon to retire.
Yeah, either that or Arizona. Yeah.
Yeah. I mean, yeah.
Well, I mean, you buy a 1,200 square foot ranch house, 30 years ago in, Fresno, and now it's, you could sell it now for $1 million or better, and come up and buy a very nice house for half that, and then pocket the difference.
Yeah. Yeah. We should have worked for the government, Doug.
I guess so.
Well, if we choose our boy Bernie, then we all will be. So anyway. All right, listen. You got some great questions in here, and I really want to get through them. And I'm going to invite you on my Monday night call with all my students as well. All right, so tell me, when's a good time to buy? When's a good time to sell? What do you think?
Well, there are good reasons to buy. Is when everybody else is selling.
Okay. I didn't realize I was sitting here talking to Warren Buffett.
Yeah, exactly. Back in 2009, a group of investors that I was a part of tried to buy this 56 unit apartment building, and it had been 2009. It had been taken over by a bank, and we were trying to buy it, and I was just scared to death because everybody and their brother at that particular point in time was fleeing real estate. I mean, they were trying to get out as quickly as possible. Here we were trying to buy something. And we bought it for $39,000 a door. And today that property is worth about $160 a door. And it has generated 3 times the cash flow of what our original purchase was. So it's like a win-win-win. But that is one reason, or one time to buy. And it's the hardest time to buy because nobody wants to buy when everybody else is getting out of the market. Yeah. And we're probably 2 or 3 or maybe 4 years out from that happening. I'm not trying to predict it, but at some point the market is going to turn. And that's when you should have some money set aside to be able to buy. So that's one reason. I'll try to go through these other ones a little more quickly. When you find a property whose rents are below market, I saw one just last week that I'm financing it, and I said, look, your rents are at least $200 a unit below market, and if he were to, it would be a good one to buy. I mean, so you could find properties even today where the rents are below market. You certainly can find properties that are poorly managed. Oh man, I would say, a quarter of the properties out there are poorly managed. Maybe more than that. Are
you kidding me? Listen. I think you're way off on that number, and I'm going to argue. I'm going to win this argument right here.
Okay.
Because most of the properties that we're looking at are mom and pop properties, and the financials that we get are atrocious. Yeah. And if I had stock and cocktail napkins, I could I'd be fine because all the financials are on a cocktail napkin.
Yep.
And it's just it's bad. And that's kind of gets back to your original point about the inefficiencies of this business.
Exactly.
And run the inefficiencies, not the inefficiencies of real estate as real estate, but the inefficiencies of this business as a business. Yeah. And what you can do to it. And that's really key. That is key. Yeah. So go on.
Okay. So the next one we've talked about already, but I need to mention it's when your vision for the property is better than the vision of the property owner at that particular point in time. If you can see how you want to manage that property, that it's going to really end up improving it, then you need to buy that property. And then the last one is when your property's neighborhood is in the path of growth. If you're seeing that there's this gentrification is coming your way, you just need to hold on because your value of your property is going to go up even if you don't do anything to it. So I think those are some good reasons to buy, and good reasons to sell. Good reason to sell is when it's a seller's market. Right now would be a good time to sell because cap rates have not come down, and yet we're in that downward slide right now, or just beginning it. And it's best time to sell is when the herd is buying, and the herd is still buying. Yeah. So this would be a perfect time to sell.
Yep.
Another reason would be if you've identified a 1031 exchange property that has more upside than the property that you currently own, sell your property, buy that other property, and because it has a higher upside. And then finally, it's just more. If you no longer are enjoying owning real estate, you know, it's time to get out, you know.
Hey, I totally agree with you on that one because it's all about the quality of life.
Mm-hmm.
It's not about making money. It's all about the quality of life. And if the thing is eating you alive and if it's not the right thing for you, that's why I always say owning real estate changes your life. And so you've got to understand, how is this going to, am I going to let it rule my life, or am I going to rule it and just let it be a part of my life? But you're absolutely right. I mean, it's because, Doug, I always joke that I'm 72 years old, but I mean, it's the wisdom of years. You just get sick and tired. Like, I just want to live a good life. That's all I want.
Life is too short.
Yeah.
I really enjoy owning my real estate, but I own it as a passive investor.
Yeah.
Actually an asset manager on 2 properties that I own, where I oversee the property management companies.
Which isn't very passive.
Doing that.
Doug, that's not very passive, mind you.
No, those 2 aren't.
Yeah.
But, I have 7 properties, and 5 of them I'm totally exclusively passive on. And the other 2, I kind of oversee the property management company. And it's like, why am I doing this? I mean, I'll let somebody else do it. It's not, I'm doing it kind of as a,
the benefit to your friends, the other investors.
Yeah.
Yeah. Now, let me ask you this, because this is, I was going to add, when you're talking about selling, we were just, I'm here in Nashua, New Hampshire right now, a little, secondary market, not even almost a tertiary, which is a great little city, but it's a small market. Down the road is an even smaller town. And a multifamily just changed hands at a 4 cap price. Now, granted, Southern New Hampshire is lights out, but like you said, it's a herd mentality. It sold for a 4 cap. Now, the guy that sold it, his family's been in multifamily for a million years, and I thought to myself, if he has been in this business this long, and he sees that property selling at a 4 cap, why wouldn't he sell everything right now? Because it's obviously in this, it's a tertiary market at a 4 cap, just stupid. So my question to you, and what you have here is, talk to me about markets and the smaller cities, the bigger cities. What's your perspective on that?
Well, one of the lessons I learned from my loser property, my loser property was located in a small little town of about 10,000. And there's a reason why there are higher cap rates in smaller areas.
Preach it.
And the lesson I learned is that when the market finally turned, eventually turned in like 2010 and 11, it took another year or 2 before we felt the benefit of an improving market in this small little town. So people say, well, I'm going to go invest in, little podunk, whatever. And because the cap rates are higher. Well, there's a reason why they're higher, and you're higher risk. And when the market turns, it's going to take a lot longer for that property or for that city or little town to benefit. So I am not a proponent of going to the small towns just because they have higher cap rates.
Unless that's where you are and that's where you live, and that's your background. Because, hey, we all know time is money.
Yep.
And one of the things about those tertiary markets is it's tough to get investment dollars in, and it's also tough to get investment dollars out.
Yep.
And usually to get that money out, it takes longer than usual. Yep. And that time translates into opportunity costs and into money that you're losing. That you got to. I mean, it's tough to quantify, but it all comes out in the wash at the end of the day. But you're absolutely right. I mean, some of these tertiary markets, unless you're there, unless like this guy's family has been there for 50 years, and he knows the market cold, then stay there. But if you're syndicating a deal and you got a bunch of investors around you and they're all looking for returns that match what the stock market's doing, podunk Poughkeepsie is not where you want to be.
Now, the exception you made, I want to expand on that a bit because I agree. The other corollary to that is that a lot of people will say, I'm going to go invest in, I live in Portland, and I'm going to go invest in Ohio as I talk about it. And I'm saying, no. Because I have learned over the years, all the properties that are in the state of Oregon that are owned by outside investors, they live in out of state.
California.
Yeah, mostly California.
Yep.
You go visit those properties, and the condition and quality of those assets have been deteriorating ever since they purchased it because they never go inspect it. They never see it. And the property management companies are just running them into the ground.
Yep.
I would tell you that you should buy a property only if you're willing to inspect it on a regular basis. And in most cases, for me, that means my assets are all within like an hour's drive, except for one. I got one that's like 3.5 hours, but most of my assets are within a being able to drive to the property, because you get what you inspect, you do not get what you expect. So you got to make sure that you don't buy in an out of state where you'll never go and visit the property.
Yeah. I mean, I tell my students, they say, well, what market should I look in? Where should I be? I said, listen, you should be where you plan on running your business for the next 5 years.
Yeah.
And, if your plan is to be living somewhere else in 5 years, that's where you should be looking for property, because you can find deals right in your own backyard. Yeah. I mean, the real estate heroes that I grew up knowing, they made their millions right here in Nashua, New Hampshire. They didn't go to Fort Worth, Texas, because some guru told them that's where you need to be. I mean, they did it right in their own backyard. You got to find the deals where you want to run your business, and you have to realize that this is a business.
Yep.
I
agree.
Yep. I love what you said about it's what you inspect, not what you expect. That's so true. So true. All right, hey, Doug, tell us about your book, because it's all about because we're trying to get your book on Oprah's book club. So tell me about your book. What will I find when I read it?
Well, what you're going to find is that the book is unique among real estate investing books. I'm going to try not to break my arm patting myself on the back, but
do it.
The typical book on real estate investing, it focuses on real estate investing. My book is more holistic in its nature. It not only talks about investing, but how do you manage a property? How do you finance a property? And then how do you prepare your property for sale, so when the day comes that you want to sell it, you can get the maximum price for it. So from that perspective, it's more holistic than the vast majority of books on real estate investing. Secondly, it's written from the perspective of not just my experience. I have 12 years of experience in investing in real estate. Some will say that's a lot of real estate experience. I think it's just marginal. What I think is that I also have had clients over the last 30 plus years that are highly successful. And I've been like the fly on the wall watching what they do right and what they do wrong. And there are certain principles that I've learned from them on real estate investing. And that's what's in the book. The book is not a checklist of this is how you go buy the property. It is more about real estate investing principles, the do's and don'ts. And then I support those investing principles with real life stories, like my loser property, so that people can understand very quickly and very easily the concepts. And I've been told, Charles, that it's easily readable. A lot of these things. I thought, after I
so what you're saying is, from my audience, there are a lot of pictures.
Yes, yeah. Well, there are, and there are graphs, and there's charts, and there's everything. But I've been, what I did, and I'm getting into trouble here by saying this, but I'll do it anyway. I went ahead and bought like 6 or 8 books on real estate investing. After I purchased, after I wrote my own, I said, well, I got to find out what
the competition's doing.
What competition looks like.
Yeah.
And God bless them, they're boring. I mean, at best, they're boring. And some of them had really poor advice in there. And we're talking about 10 cap rates and things like that.
How about this one? Here's a bit of advice. I'm sure you're going to love this one. And everyone that listens to my podcast knows I come back to this one. You can always overpay for multifamily property because the prices on them just continue to go up.
Yeah. That's yes, that is just an awful bit of advice. And most of them were weren't that there was such bad advice. It was that they were written like a checklist on how to buy a property.
Mm.
And I think you really need to have more an understanding of the investment principles. And so that's where I spend most of my time. And again, it's not just on the investing side, it's also on the financing, the managing, and then eventually putting together the property to sell it in the future. So I think that's what makes the book different than the vast majority of the books out there.
All right. Now, you're also a CCIM, which I haven't even touched upon because that is, I actually, are you familiar with the Society of Exchange Counselors?
Yes, I am.
Oh yeah. For those who are listening, it's secounselors.com. But you need a CCM like CCIM like Doug to get you to the table. But I was teaching in Ohio one time, and I come to the part. I said, listen, every property manager, every property management company, anybody in that business, they've all got a 3-letter acronym after their name. And I'll just tell you right now, I have fired all of them. I said, except the CCIM. Now that's one guy that every time I've ever worked with a CCIM, it has been the most professional experience ever. So that's I see that you're a CCIM, so I know you've gone through the gauntlet there to get that designation. So good for you, bravo.
Well, thank you.
Yeah. All right. His name is Douglas Marshall. The name of the book is Mastering the Art of Commercial Real Estate Investing. He's been on my show, and he's been a great guest. And I've got so much more to talk to him. I'm going to invite him over to my Monday Night Live call with all my students, where we really get down and dirty. And he thinks he got run roughshod by me. Wait until he meets my clients. He'll love that time. So, all right, Doug. Hey, thank you so much for being on the show. It's great to have you, and I look forward to talking with you soon.
Well, Charles, it's been a pleasure.
Thank you very much.
Thank you.